Um, all right. I think we can already kick it off. Welcome everybody, first of all. Thanks for joining, as I said, on a Sunday morning, 10 a.m., and it can be quite early. But thanks for being there. First of all, today we're gonna talk about MFA, Managerial Finance and Accounting today. And in this free training, let me take the pointer. In this free training, we're gonna discuss payout policy and also financial distress. But just before we start, a quick introduction of myself. So I see a lot of familiar names already. So a lot of you maybe already had a course with me in the past. So you might already know me. For the others, I'm Marwan, half Belgian, half Egyptian. Lived in both countries, by the way. Here's my phone number you can see on the screen. I'm also in the group chat, the IB group chat, I mean the big one. So of course, if you want to text me regarding anything, you can always feel free to shoot a text. I'm currently in my third year of international business. I'm going to exchange in Universitat Pompeu Fabra in Barcelona from January onwards. So I'm really looking forward to that. I am doing the finance major. That's why I love usually giving and like taking finance courses like MFA, like corporate finance. All these courses, also you might remember me from finance last year. In my free time, I love playing tennis and football. Those are the two sports I really follow and enjoy playing and following. And my average tutor rating is 9.4, more or less, a bit more. And yeah, the courses I already gave QM1 and 2 multiple times, economics, finance from last year, now MFA, and I already gave MFA last year actually. So that's pretty much it about me. Of course, if you have any questions about, I don't know, the exchange, because I know it can be quite confusing. I remember last year myself when I had to like apply, I didn't know what to do, when to apply, what to do, what documents to send, what survey to answer, this kind of thing. So if you have any questions, of course, feel free to ask me anytime, either here in the chat or via my phone number. But yeah, that's pretty much it about me. Of course, if you have any questions, please feel free to stop me anytime. And enough about me. Let's talk about the Athena method a bit. So we first have some theory that I provide you with. I give you examples to really apply this theory to real life cases. And then, of course, we have practice questions where we basically practice with past exam questions only. So all the questions you're going to see today and in any Athena training is going to be a past exam question. So we think that the most relevant way of learning and applying the theory is by practicing with actual questions that they could ask in the exam. That's why all the questions are past exam questions. And we learn the most by asking questions. So please, guys, honestly, if you have any questions, if you have any uncertainties, if you have, I don't know, anything that you want me to explain again, if you think I'm too slow, if you think I'm too fast, please, please, please just type in the chat, speak out loud. I don't mind. It's even better if you speak directly. And yeah, so honestly, don't hesitate. I'm here to help you guys. So of course, if you need me to repeat something, I would be very happy to do so. Also, we have a 24/7 WhatsApp aid. That's if you purchase the full training, of course. Talking about full training, just a quick difference so that you know between the free and the full training. So today we have a free training. We have, yeah, as I said, two topics we're gonna talk about: payout policy and financial distress. Everything is with a past exam, and of course, in an hour and a half. So this meeting is going to be around an hour and a half, maybe a little bit more, maybe a little bit less. Of course, we cannot cover the entire exam material, the all of the chapters, know how many there are all in all, but a lot. Today we're going to only cover two chapters, which is already quite a lot for a training. So of course, we cannot cover 100% of the exam material. And here you can see, as in the Sunday morning, a few people joined, but of course, this kind of attendance is kind of what you're gonna expect for the full training. So around 10 to 15 people usually. So small groups, you have room for all of your questions. We can have like a cool atmosphere and everything. And there you get a 24/7 WhatsApp aid, of course, 24/7, as long as I'm awake, right? So if you text me at 3 a.m., I'm not sure I'm gonna answer right away, but that's not the matter. Just quickly, so we said we have definitions, formulas, and then independence because you're gonna solve exam questions. And by the way, I want to make this session as interactive as possible, so it would be amazing if you could turn on your cameras to make it a bit more interactive between us. And also want you guys to participate a bit. So I'm gonna maybe sometimes ask a few questions to you guys to see if you're really following. So it's better for you and better for me. Of course, I won't ever force anyone to answer. If you don't know, it's no problem. We're here to learn, but at least give it a try. Just Quickly, an exam analysis I made myself of MFA, so you can see the two topics we're gonna discuss today. So capital structure in imperfect markets, basically chapter 16, if I'm not mistaken, and payout policy chapter 17. These two are quite heavy in the exam because you know half of the training, half of the exam, sorry, is finance. The other half is accounting. So you can see here in the finance part is kind of yeah almost a third of the entire exam. So it's very important to know these topics by heart. PR policy is a lot about theory questions. I really want you guys to understand all the theory to answer all the multiple choice questions because they love to ask tricky questions about that. So we're gonna see every kind of trick they can ask you today so that you get 100% prepared for the exam. Just before we start, quick icebreaker to you guys. How much confidence you guys have in your knowledge of financial distress and payout policy as of now before this training in week 4, now that we're heading to? So you can answer either in the private chat, public chat, you can speak out loud, you can do whatever you want. I would just be curious to see how confident you are with those topics. So feel free to type in the chat. All right. I see some six, some fives, six. All right, so I see it's not a topic you look very, very comfortable with, but it's normal. It's very difficult. So hopefully by the end of this training, you'll be able to get everything. And I want that six, five to get at least an eight, a nine, hopefully for some of you a 10. So that's my goal for today. Raise this confidence level. All right, perfect. Moving on, the agenda as we said, so chapter 16 and then chapter 17, we're going to start directly with 16. So just before we start, as usual, feel free to use a private chat, speak out loud, get a sheet of paper because we're going to practice. I wait for you, so just let me know if you need more help, if you're struggling a bit. There is no shame on that. We're just here to practice. I'm here to help you, and don't be afraid to make mistakes because failure is not the opposite of success. It's part of success, part of the journey, right? All right, so chapter 16 directly, just before we start, as usual, if I'm too slow, too fast, just let me know and I'll explain again. All right, that's the goal for today. That's not the question I want you to solve now. It can be very difficult. You see, you want to calculate financial distress costs. You have a lot of data. It's very difficult, and we're going to see how to solve these questions today. But first, the theory. So, default and bankruptcy. Four. That's a big topic as well in MFA. All right, we have debt financing. What is debt financing is basically when the company has the obligation of paying back the debt plus the interest, because we know that the company can choose to finance its own company by either equity or debt, a lot of debt, a lot of equity, a mix of both, right? It's like kind of a big puzzle, and there's no right or wrong answer always, right? But the more debt you take, the more risky it is because you have to pay back a lot, you have to pay back the interest, and yeah, a lot of company is debt, of course. So you of course have to pay the interest, but when you fail to do so, to pay the interest, where you are in what we call default, right? So the risk of default increases with leverage. The more leverage, the higher the possibility of you not being able to pay back your debt holders, right? So let's say you made a loan at the bank, you need to pay an interest of, I don't know, 8%, just a random number. You can't do it, you can't afford it right now, you are in default, right? And the more leverage you have, leverage is debt. So the more debt you have, the more likely you could be in default. Default is not being able to pay back your own debt, your own interest. So, in the Modigliani and Miner proposition 1, in the perfect capital market, then the bankruptcy and default do not affect the firm value to the total investors, right? So, bankruptcy and default is just a change of ownership. Remember from Finance 1.5, bankruptcy just means that the ownership of the firm is transferred to equity holders, so shareholders, to debt holders, for instance, the bank, whoever loaned you the money, right? So bankruptcy is just a transfer of ownership. The market value, the total firm value of the company does not change. What changes is who owns the company, right? So the value will be instead transferred to debt holder, but the value itself remains the same, right? That's very important to know. Bankruptcy does not change the value of the firm, it changes the ownership of the firm, right? And of course, when firms face bankruptcy, there are two plans. Either liquidation, sell your assets to get some liquidity and pay back your debt, or reorganization. You can reorganize your company, set things differently, fire some people, yeah, reorganize the entire structure to be able to survive and still be able to pay back by selling part of your company, right? So that's reorganization. And with that, we've got several different costs, right? We've got direct cost of bankruptcy and indirect cost of bankruptcy. These are two extremely important concepts. So indirect and direct costs, right? So direct costs are everything that is directly caused by the bankruptcy. For example, legal fees, experts fees, consultant fees, appraiser fee, broker fee, all the fees that are directly involved by the bankruptcy. So because you're bankrupt, you have to pay this guy that amount. You have to pay that guy that amount. You have to pay. Every time you have to pay, you have to pay. Indirect cost is not something you directly have to pay, it's something that you don't get. So it's a loss of customer because you are bankrupt. You lose your suppliers because you are bankrupt. You lose your employees because you are bankrupt. You lose receivables. So that's not something you pay, it's rather something you lose, right? You have to sell your assets. You have to reorganize your company. So indirectly, it's caused by the bankruptcy, but you don't have to pay yourself. Like a loss of customer, you don't have to pay, I don't know, 1 million to customers. It's just that you don't get the money from customers. Rather than direct cost of bankruptcy, which is you directly paying the broker, directly paying the expert, directly paying the consultant, all these things, because you are bankrupt. So that's a huge difference between both. Direct cost you pay, indirect you lose, right? And that's something they ask you at least 2 times during the exam. Always two theory questions about direct cost and indirect cost of bankruptcy. That's extremely important, and we're also going to practice with that today. Now, is this clear for everyone so far? Bankruptcy, direct and indirect costs, what it's about, because that's extremely important, right? You can answer in the public chat, private chat, as you wish. Yes, in the chat. All right, perfect. Of course, if it's not clear, of course, you can always tell me and I'll explain again, right? I want you to really understand all the topics to be able to ace the exam. Because the exam, the finance part is, yeah, a bit more tricky. Accounting, I'm not gonna say easy, but I personally found it easier than finance because it's always kind of the same calculations and they can't really trick you, right? It's just calculation. You have to repeat it again and again, you'll understand. Finance, you really need to understand the theory, apply it, and yeah, also do it calculations that can be a bit more difficult. Moving on with the financial distress costs and the firm value, because we know from the trade-off theory here that the value of the levered firm is equal to the value of the unlevered firm plus the present value of the interest tax shield minus the present value of financial distress costs. Now, how do we calculate all of those, right? The value of the unlevered firm, we just know it's the shares outstanding times the price per share. It's kind of the market value of the firm. That's the unlevered firm because unlevered means only equity and equity is market value, correct? So we know what is the unlevered value of the firm. Levered value can either be computed by adding all these terms all together or just taking this share price after that has been implemented. For example, I can tell you now that the company XYZ borrowed X million to the bank, their share price went up to X amount, and they still have X amount of shares outstanding. You can compute the value of the levered firm, right? So now to compute the levered value, the unlevered value, and the interest tax shield. What is the interest tax shield? Is basically the tax benefit of having debt, right? The more debt you have, the less you have to pay of taxes. And of course, interest tax shield is always the debt, call it D, times the tax rate on the debt, right? So the tax, for example, here, corporate tax rate, this is the interest tax shield. And then the financial distress cost. Usually in the question, it's always what they're going to ask you. So they're going to ask you to calculate the present value of the financial distress cost. So they might just give you like not directly, but you can calculate the present value of interest tax shield. You can compute the unlevered value and the levered value, and then they ask you for the financial distress cost. Otherwise, they just give you a cost and a discount rate, and you just have to discount your cash flows, and this would just be the financial distress cost. But most probably, it's just going to be a question where they give you this, that, and that, and they ask you for the financial distress cost. And we're also going to practice with that in a second. So that's extremely important, and they always ask it in the exam every single year. This is something I can guarantee. And you can see here, of course, The more distress cost you have, the lower the value of the firm, of course, because we see it has a negative impact. So value of the levered is a levered plus interest action minus financial distress. So the more and the higher the distress cost, of course, the lower the value of the levered firm, as you can see on this graph. Any questions so far? And then we're gonna practice right away. Or is it clear for everybody? Yes, I see it's clear in the chat. Amazing. All right, now moving on to the next question. To the first question, actually, we start slowly and then we're gonna have a calculation. So, first past exam question. So these questions are directly taken from past exams. Which of the following is not a direct cause of bankruptcy? So how are we gonna do that? You guys can answer in the private chat so that others are not influenced by your answer. And once more or less everybody is done, we can move on to the next question. So in Zoom, there is the private chat. When you type new chat, you type it to me. And then once you think you have your answer, if you have questions, of course, if you need me to help you, please feel free to ask me and I'll help you out in your reasoning. All right, I already see some answers. Right. All right, just maybe waiting for a few more answers. I already received quite a lot. We're waiting for one or two more and then we'll solve it all together. Yes, great. One more answer. These questions might seem a little bit easy, but they are post-exam questions, so it's always good to practice with them so far. Great, very nice. I think more or less kind of everybody answered. Maybe I'm missing one, two people. Of course, if you don't know, it's no problem. We're gonna explain right away. So very good from everyone. Which of the following is not a direct cost of bankruptcy? Of course, it's the loss of receivable because we said direct cost is a cost that you directly incur linked to the bankruptcy. Indirect means that you are losing something. So not direct, you lose a loss of something. Direct, you pay. Very good for everyone. Of course, if it's not clear for someone, maybe for those who did not answer, I hope it's clear now. If it's not, you can always feel free to ask me later on. Now, a bit more difficult. So that's the question I said I wanted you guys to be able to solve after this chapter. So assume an world with bankruptcy costs and financial distress costs as imperfections. So we said, of course, world is a perfect world, but it has imperfections, this one being bankruptcy costs and financial distress. So AST is currently an unlevered firm with 25 million shares outstanding at the price of 10 per share, and they pay a corporate tax rate of 35%. They borrow 100 million and they use it to repurchase shares. The shareholders expect the change in debt to be permanent and the share price to rise to 10.85, so 85 cents more expensive. Then we want to know what the present value of the financial distress cost is. So of course, I highlighted some important factors in the question. If you have any questions, please let me know. If you need the formula again, please let me know. And if not, I'll leave you some time to think about it and solve it on your own. And once again, if you're ready, you can send me in the private chat. And of course, if you have questions, you don't know how to solve it, you need some help, please just tell me, and I'll be very happy to help you all. All right, already got some answers. Very nice, everyone. Just waiting 1, 2 more minutes that everybody's done, and then we can solve it all together. Do you guys still need more time, or should we solve it all together? Can tell me in the chat so that I know, and then we can solve when you're ready. All right, let's do it all together then. Very nice. So for example, Evie had the right question. So Evie, would you like to help me explain this question to everyone? Of course, I'm here to help you out as well with the explanation, but just kind of the reasoning you used and how you got to your answer.
Yes, I used the formula we saw before from the value levered firm is value unlevered firm plus the present value of the interest tax shield minus the present value of the financial distress cost. And for the value of the levered firm, I just did the 25 million shares times 10 per share, and then you get 250 million. And for the present value of the interest tax shield, I just did, they bought, I think, 100 million. So times the corporate tax rate, that's 35%, you get 35. And then for the value of the levered firm, so after they borrowed the 100 million is 10.85 times the 25 million shares. That's 271.25. And then I just filled it in the formula, and then the remaining number is 13.75.
Outstanding. Lovely job. Evie, thanks for sharing. So exactly, that's how you should solve this question. We know with the trade-off theory that the value of the levered firm is equal to the value of the unlevered firm plus the interest tax shield minus the distress cost, the financial distress cost, right? They ask us for the financial distress cost. We have all the information we need to find the value of the levered firm, the unlevered firm, and the interest tax shield. So all we just have to do is plug in the numbers and find then the financial distress cost. So we had 25 million shares outstanding when when the price was the firm sorry was completely unlevered. So it was $10 per share. So that the value of the unlevered firm was 25 million times $10, which is 250 million. Then, after the leverage happened, so after they took on debt, 100 million of debt, the share price rose to $10.85 per share. We still have 25 million shares outstanding, and that gives us 271.25 million. The interest tax shield, we know it's always going to be the debt, so in that case, 100 million is what we borrowed and the times the corporate tax rate. Corporate here tax rate is 35%. So we just do 100 million times 0.35, which gives us $35 million. And now we have all the numbers we need to plug into the formula and find our financial distress cost. So we do 271.25 is equal to 250 plus 35. And if we solve, then we put distress cost on the other side, we get 250 plus 35 minus 271.25, and we get this lovely number of $13.75 million. Is it now clear for everybody? Because for this one, it gets a bit more difficult. A lot of people were a bit struggling with it. Now, is that clear for everybody, or should I explain again? I see it's clear. Amazing. Clear, everyone? Because this is a question that pops up every year. So very important to master this kind of question. All right, I see. Yes, it's clear. Amazing. Of course, if you have any questions later on, you can always ask me. And if not, we can move on to the next one. According to trade-off theory, which of factors does not influence the present value of financial distress costs? So I'll let you think 1, 2 minutes, and then we solve it all together again. Last few seconds, and then um, yeah, we're gonna solve it all together. Yes, perfect again. All right, let's solve it all together. For this one, according to the trade-off theory, which of the following factors does not influence the present value of financial distress cost? So answer A, the discount rate used for calculating the present value of distress cost. Of course, if you have different cash flows with a discount rate that you have to use because on the present value, so always when we ask for the present value, we have to discount our cash flows, always, no matter what happens. Of course, the discount rate has a big influence on the calculation, right? Because let's say we have a cash flow of 10 million, right? And we have uh, the discount rate is, I don't know, 1.1. And of course, the value after the discount has been applied is different from if the discount rate was 1.3, for example, right? There is a huge difference. So, of course, the discount rate has a big impact on the present value of the distress cost because this is literally part of the formula. So, of course, it has an impact. So, A is correct. B, how distress costs are allocated. It doesn't really have an influence on the present value. Let me explain. If you have, I don't know, 50 million of financial distress cost. At the end of the day, no matter how much you allocate, how you allocate them, you're still gonna have 50 million of financial distress cost, right? Let's say you pay, I don't know, 10 million of, I don't know, accountant, reorganizer, you pay 20 million to a lawyer, you pay 10 million to experts and so on. At the end of the day, you're still gonna pay all that amount, right? No matter how you distribute it. All the distress is allocated in a certain way. It can be allocated in different ways, but at the end of the day, you have the same distress cost. So this does not influence the present value. The present value is the cash flow divided by the discount rate. Let's see why C and D are correct as well. So the likelihood of financial distress, of course, the more likely it is to be in financial distress, then the higher the financial distress cost, right? Because of course, if you're almost certain to go bankrupt, then the distress costs are gonna go a bit higher. If just very unlikely, but there's a possibility they're gonna go lower. You might just need to hire an accountant or something to see what's happening. And the size of the potential distress cost, of course, has an impact on the present value because the size basically is how much you have to pay, and is basically the numerator on the equation. So the cash flow divided by the discount rate. So the cash flow is basically the size of the potential distress cost. So here in this case, it's B. So the allocation refers to how these costs are distributed, but the total present value depends on the expected magnitude, probability, timing, and on how they are shared, right? Is that clear for everybody? Yes, great. Nice to hear. All right, perfect. Moving on to the next question. Another one, because I think I even took it from the same exam of indirect and direct costs, and then we're gonna have one final question for this chapter, and then we'll be able to move on. So I'll leave you maybe 1 minute to solve this one. Now it should go relatively quick. And once you have your answer, you can tell me in the chat. All right. I received a lot of answers. Very good job again, guys. You're really doing great today. Very nice to see. So, which of the following is not an indirect consequence of financial distress? So, A, bankruptcy reorganization costs. So that's a cost you have to occur directly, meaning that it's directly the one that is not an indirect consequence. That's a direct consequence because you have to pay. It's a cost you have to bear linked to bankruptcy. So A is already the answer. Let's check B, C, and D to be sure. B, inefficient asset liquidation. Why is that indirect? Because of course you have to sell your assets at a lower price to get a higher liquidity right away. Liquidity is the money that you get. For example, you have properties, I don't know, wherever. You know, for example, real estate is not really liquid because you need to find a buyer of your house or your apartment or your plant or whatever in order to get the money. So in order to get it quickly, you have to sell it maybe at a loss, at a lower price so that you get it. So B and C are kind of the same thing. That's why they are indirect consequence. And then the loss of customers, we said everything that is a loss is indirect. Everything that you pay right away is direct. So answer A is correct in that case. Is it clear for those who had a different answer than A now why A is correct? Yes. All right, perfect. Moving on to the last question of this chapter, and then we move on to chapter 17. Maybe a bit more tricky, the question in the chapter coming. So ABC is currently a no equity firm. They are considering adding leverage to capital structure. The CFO has made the following estimates of the present values of the interest tax shield and financial distress costs at six different levels. So when they have zero debt, 10 million, 20 million, 30 million, 40, and 50 million, and assume that ABC can only choose these six levels of debt. So then what would be the optimal choice for ABC of debt, taking into account the interest tax shield and the financial distress cost? So I'll let you think a bit. If you need help, if you don't know how to solve this, you want me to help you out, please just tell me in the chat, and of course afterwards we'll solve it all together step by step. Few more seconds, maybe 1, 2 more minutes, and then we'll be able to solve it all together, step by step, and explain you the reasoning behind it. Right, let's solve it all together, step by step, using the reasoning behind it. So, I saw, for example, here that Federico here had the correct answers. So, Federico, if you would like to explain with me what is the reasoning behind it, how you got to your answer, which is correct, very good. The stage is yours.
Thank you. So I think the easiest way here is just going through the answers. So since the value levered of the firm is plus the present value of the interest tax shield minus the present value of the financial distress costs, you can just go ahead and look at what the maximum value that you can create here is. So obviously at zero, you're creating zero value. At 10 million, you're creating 2.5 million of value, so that's already more favorable. And then at 50 million, you're actually creating negative value. So you're creating negative 0.3 million in value. So that's actually less favorable than zero. And then at 30 million, you're creating the most value at 3.05 million.
Exactly. Very nice explanation. Amazing. That's how you do it. So as he said, the value of the levered firm is the value of the unlevered, which is not given here, but so we don't really care, plus the interest tax shield minus the financial distress cost. So the bigger the difference between interest tax shield and financial distress cost, the higher the value we get for the company, right? As he brilliantly explained. So at zero, you get no value added, right? The difference between interest tax shield and financial distress cost is zero. Here, the difference is 2.5, so we get an added value of 2.5. At 10 million, at 20 million, we get an added value of 2.8, difference between 3.6 and 0.8, so 2.8 here. Here, between 4.25 and 1.2, there is 3.05, as Federico mentioned, here of added value. At 40 million, we have 1.7 million of added value. And last but not least, for the 50 million, we have a negative 0.3 million of value. So that's even worse than zero. If you check the answers, what is the optimal level? So is it 10 million? No, because 2.5 is lower than, for example, 2.8 and 3.05. Is it 50 million? No, because 50 million is negative. And then is it 30 million? Of course, because it's the highest difference between interest tax shield and financial distress cost. So here, the answer is D. Very nice. Is that clear for everyone now, how to solve this question? Because this question comes up literally every single year in the exam. So very important to know it as well. That's why I put it here, because every year they ask it with different numbers, of course, but every year they ask it. Is it now good for everybody? For those who didn't have an answer, yes, I see yes there. Nice. Great. All right. Very nice job, everyone, on chapter 16 on financial distress and management incentive information. And now we can then move on to chapter 17, payout policy, which is a bit more heavy in terms of theory and reasoning, and all the questions are mainly theory questions that can trick you with, multiple choice, which of the question is, which of the answer is incorrect, which one is correct, this kind of thing. So we are here to practice every single trick they can give you and explain all the theory as good as I can. And of course, questions, you stop me, too fast, you stop me, too slow, you stop me, you know it. All right, distribution to shareholders. So payout policy. You've got two choices when you have extra cash, right? You have extra money, you can either retain the cash, right, in order to increase just your cash revenues just in case, or invest in new projects, or take on a new investment, whatever. So you have either the possibility to retain the cash, you can just save it on your bank account just in case, or invest in a new project, I don't know, expand to another country, whatever you have in mind with your company. That's retaining cash. But you can also pay it out. You can pay it out to shareholders in two ways. Either a share repurchase or paying a dividend. So what is a share repurchase? What is a dividend? Share repurchase is just when you go back on the market, you pay back your own shares to gain more control on your own company again and increase your earnings per share. On the other hand, you can pay dividends, which is kind of um, not gonna say a bluffing thing, because of course you can just pay a dividend, but of course we're gonna come back to that. You can have dividend signaling of just saying, hey, we have cash, we have money to show that we have cash. We pay every single investor an amount per share to show that, yeah, we are financially stable and you can easily invest in us. That's just kind of a way of saying, please invest in us because you see we have money, right? And it's also something good for investors because on top of the capital gain that they would have, so let's say they have a profit on the share of, I don't know, 10%, on top of that, they get a dividend. So it's even better for them. That's a way to attract investors, paying dividends. And we're going to come back to everything, all of that during the explanation of the chapter. But you have to know you can either retain the cash or pay it out, either as a share purchase or as a dividend. So with the share purchases, we have four different types of open market repurchase, tender offer, Dutch auction, and target repurchase. And we're going to define all of these four concepts. So just a share repurchase buys shares of its own outstanding stocks, and we have different kinds of share repurchases. The most common classic one, the open market repurchase, just go on the public stock exchange, you buy back your shares, right? You're trading, you're paying back your own shares that are currently trading on the stock market at the price of the market. That's the open market repurchase. That's the first type. Easy, you just go on the market, you buy them. Second type, sorry, is the tender offer. What is the tender offer? It's just buying shares at a pre-specified price, usually set a substantial premium to the current market price. Why would you do that? Because you can secure that you have a high amount of shares at a, for example, premium. Let's say that you want to buy, I don't know, 10 million shares outstanding, rather than have a brokerage fee and everything, you can just buy them at a premium directly to a specific shareholder every time, and then you can get them, sorry, directly. Although it's at a premium like this, everybody is happy. The seller gets a profit. You can buy them without the brokerage fee and everything. So yeah, you pay a bit more, but you're sure to get a lot, right? Third type is the Dutch auction, when the firm lists different prices which are prepared to buy shares while the shareholders indicate how many they want to sell. So it's basically a mix and match, right? You can say, okay, I'm willing to buy 100 shares at this amount, 200 at this amount, and the shareholder says, okay, I can sell you that many for that price, and just kind of selecting every time, oh, I can buy this at that price, this at that price, and you basically mix and match all the actions you have with the different investors, how much you're willing to sell and how many. That's the Dutch auction. You pick from investors. And then last but not least, target repurchase. So basically repurchase shares from a big shareholder, right? Let's say somebody that has a very high stake in the company, a lot of shares. We can tell him, hey, we'd like to have a share repurchase. We'd like to buy a lot of shares from you, so we can directly negotiate with him. You can usually want to negotiate at a discount, so having, I don't know, 10%, 20% discount, because you buy everything from the same guy, right? So it's kind of like the tender offer, but tender offer is from different people. Target purchase from one particular investor, and you buy almost all his shares. So you want to negotiate with him. He makes a profit, you make kind of a gain because you buy them a bit lower than the actual price, that everybody is happy. Target purchase is just targeting one big investor. Is the difference between those four concepts clear for everyone? Because that's something they ask you also in the yeah, in the exam. I say yes in the chat. Amazing. Moving on. I see another. Yeah, okay, yes. Okay. Here we have an example of a company paying tax. So we have ABC Corporation, a tech company, we don't care. They decide to distribute some of its earning to shareholders, so they declare a dividend of $2 per share. And that date is the declaration date, that is set for November 1st. Then the shareholders are recorded on the record date, the 15th, for example, and they receive the dividends. At the ex-dividend date, 13th of November, nobody is able to buy the stock to gain the dividend. Let me explain all of this concept. That's just how they can tell you in the text, but let's have a timeline of everything. First of all, we have the declaration date, when the board declares a dividend, either special dividend or normal dividend. That's the declaration date. For example, here on the 20th of July, they declare we're gonna pay a dividend, right? The ex-dividend date is the date after which, if you buy the stock, you won't receive the dividend. So it means that, for example, here is the 15th of November. If you buy it on the 14th of November, you still receive the dividend later on the payable date, right? But if you buy it on the 16th of November, you don't get the dividend anymore. You get the stock, but you don't get the dividend. Otherwise, You would basically get a profit of directly getting dividend and see the price change afterwards. So ex-dividend date, you cannot get the dividend from that date onwards. Record date is basically the date where everybody is recorded. Okay, he's allowed to get the dividend, he's not allowed, he's allowed, he's not allowed, this kind of things. And the payable date is when you get the money directly. So basically, record date, you know that you're gonna get it. Payable date, you actually get the money. That's two very similar dates, but just the difference that payable, you get the money. Record date, you're recorded as a dividend holder. We've got different types of dividends. We've got special dividend, which is a one-time dividend larger than regular dividend. Let's say, for example, a company had earnings of, I don't know, the expected earnings that were 20% lower than the actual one. So they actually had 20% more than they planned. They say, okay, guys, it was great here and we want to thank you, our shareholders. That's why we're gonna offer you a special dividend this time for this month. Especially, we have a dividend of, I don't know, 10 euros per share, just for once. And then we're gonna come back to the normal dividend. But just this time, we have the $10 per share. That's a special dividend. We have a stock split dividend, which is basically offering a dividend in terms of shares and not cash. Let's say that they were planning on offering $5 per share. Now what they can do is having $5 off share per share. For example, let's say that a share is $10, right? There's an example. For every share, we want to offer $5 per share as a dividend. So we would offer 0.5 shares to every shareholder. I don't know if that makes sense. So we just, instead of having share dividend in cash, we have the equivalent of the cash in terms of shares. That's a stock split dividend. And then the return of capital, liquidating dividends, just dividends that are attributed to other accounting sources. That's not extremely relevant for the exam, but I just put it there just in case. One more thing on dividends. Dividends are completely up to the company, right? They can either pay one, they can not pay one. It's just up to them. They don't have to legally pay any. And it doesn't have to be on, I don't know, semi-annual basis. Annual basis can be, for example, every, I don't know, quarter. It can be every month. It can be every year, every semester, whatever. But it's just up to the company. So they basically choose what they want for them, and they have no legal obligation to pay a dividend always if they paid it before. That's just something you gotta know as well for the dividends. All right. Comparison of dividends and share purchase. So we have a Modigliani Miller and the different dividend policy irrelevance. So in perfect capital markets, holding fixed investment policy of a firm, the firm's choice of dividend policy is irrelevant and does not affect the initial share price. Why is that? Let me explain. So first we have first scenario of just paying dividend with excess of cash. We have this formula here that is not extremely important if you want to calculate just the price with dividend or price without dividend. It's just to put it there, not really important for the exam. They usually never ask us that. And what is important is that after the ex-dividend date, so the date at which you will not receive the dividend anymore, the share price will reflect only the dividends in subsequent years, right? And the share price drops by the amount of the dividend when the stock begins to trade ex-dividend. Why is that? Let's say a company has, I don't know, assets of 10 million, they have 100 million shares outstanding, whatever. Of course, if they pay a dividend, their assets, their market value is going to shrink by the amount of the dividends they pay, right? Because they have less cash, they are paying out, so they have less value in the firm. So they're paying more, they're having less, of course. But the number of shares outstanding remains the same, right? So then what you want to do is just always have a fair share price in perfect capital markets. So always in perfect capital markets, the share price is kind of fair. It's not the market price is a fair price. Then you have to divide the number of like your assets divided by the number of shares outstanding. But then the change will be proportional to the dividend. If you paid everybody a 3 euro dividend, then you're gonna have a reduction of that amount in your assets, reduction in your market value that you divide by the number of shares outstanding, and the new share price will be exactly the same as before minus the dividend. So basically, for the investor, it didn't change much except that he has cash now that he didn't have, he had before a share. For example, if you get the dividend of 3 euros, then the share price drops by 3 euros afterwards, but he gets the cash. That's why the share price drops right afterwards, but it doesn't change much for the investor if he already had the share before the ex-dividend date. Is that logic clear for everyone? That it drops by the amount of the dividend to basically compensate for the dividend being paid. In perfect capital market, always. Because in real life, it's not exactly the same. Okay, I see yes. If it's not clear, please just stop me, but it's extremely important to understand. That's very nice. And the share purchase logic is the same. So the share price remains the same after the share repurchase. An open market share repurchase has no effect on the stock price, and the stock price is the same as the cum dividend price if a dividend were paid instead. What's the logic behind it? I give you an example. Once again, it's the same reasoning. So imagine you have a company that trades at 100 euros per share and you have 1,000 shares outstanding. You buy back 10,000 of shares. So 10,000 euros of shares that you currently have assets of 100,000. So market value of 100,000, right? You buy back 100 of your shares because they are worth 100 euros and you want to buy 10,000 of shares. So you buy 100 shares, 100 times 100 at 10,000, right? Now you only have now 900 shares left because we had 1,000, we bought 100, so we have 900 shares left. But now our assets are worth 90,000 because we had 100,000 of assets and we bought 10,000 with those 100,000. So we are left with 90,000. So the new share price is still going to be 90,000 divided by 900 shares, which is 100 per share. And the price remains the same, although we bought new shares. But it's just that as our assets diminished, it's the same logic as the dividend. Our assets diminished, then we have less market value, and we still have the 90,000. We have 90,000 now and we have 900 shares outstanding on the market because we bought 100. Is that also clear for everybody? If you understand those two logics, those two reasonings, then you already get more than 50% of the chapter reasoning. That's extremely important. Should I explain again or everybody understood that? Can tell me in the chat. I see it's clear. Perfect. So yes, that it's clear or that I should explain again? Okay, I see it's clear. All right. Perfect. Then if you have any questions, you can stop me again, of course, but that's extremely important again. And this leads us to a theory, the homemade dividend. It means that investors are then indifferent between receiving a dividend or a share purchase of the firm. Why? Because by reinvesting the dividend or selling the shares, they can replicate either method with their own, right? Because they said the share price never drops or the share price drops by the dividend. So they get the dividend and reinvest it, or they just sell the amount of shares that is worth the dividend, they can replicate it on your own. So basically, in perfect capital markets, very important, so in the Muglin and Miller word, investors are indifferent between those two, if you follow the reasoning we just had. So basically, you can replicate either method on their own, and that's pretty much it. That's why they don't have any preferences when we are in a fully perfect capital market. If you introduce taxes, then it's different. But if you don't have taxes, they're completely indifferent between dividends or share purchase. That's extremely important, and it is something they love to ask in multiple choice questions. All right, alternative policy number 3, high dividend. As in previous cases, the share price is unchanged as firms have to issue equity to afford high dividend, blah, blah, blah. It's the same logic as before, but this time they pay a very high dividend. That's just another possibility. Fourth one, sorry, is dividend policy with perfect capital market. So a firm's free cash flow determines the level of payouts that it can make to its investors. So of course, you have more cash flow, you have more possibilities to offer to your shareholders. That is just logic. You have more money, you can pay out more. Have less money, you can pay out less. It's just common sense. But if we have imperfections, what we're going to see in the next slide, then it's maybe optimal for some investors to prioritize, for example, a share purchase over dividends, and we're going to see why. So now let's assume we still have a Modigliani and Miller world, but we have the taxes as an imperfection, right? So shareholders are taxed according to the dividend tax rate on dividends and have to pay capital gain taxes if they sell shares. So if they sell shares, they have to pay the capital gain rate. Let's say they have a gain of 10%, they're taxed on that capital gain rate. And on the dividend, they're also taxed on the amount of the dividend. Depending on the dividend tax, they are taxed on how much you receive. So if both rates are not equal, then of course an investor would prefer one over the other, right? So a higher tax rate on dividends also makes it undesirable for a firm to raise funds to pay a dividend. Why? Because if they basically use their share repurchase, the investor is better off because they will have to pay less taxes on the gain rather than paying the tax on the dividend. So of course, if the capital gain is taxed higher than the dividend, then of course you prefer a dividend over capital gain, right? Because just you have to check, it's common sense, which of them is taxed at a lower rate, then you check which one, and this one is the most preferable one. If you're taxed more, you're less likely to be happy with that, of course. You want to have the highest amount of money, of course, after tax. So, optimal dividend policy with taxes. The optimal dividend policy, when the dividend tax rate exceeds the capital tax rate, is to pay no dividends at all, right? Because if we have a dividend tax that is higher than the capital gain tax, then of course you don't pay dividends and use a share repurchase instead. Because for the company it's the same, and for the shareholders they get more money, they get more bang for their buck, right? So that's always better for an investor when the dividend tax rate is higher than the capital gain rate. And we've also got the dividend puzzle, so it's firm continuing to issue dividends, although they have a tax disadvantage, right? But it can be beneficial for them because for them they'll maybe sometimes taxed less on the dividends than on a share purchase with all the brokerage fees, etc. So depending on the companies, of course, it depends on a lot of factors, right? The location, which country you're in, the policies. I don't know. For example, we have different financial partnerships, whatever. For example, with Trump, it changes a lot as well on the way dividends, taxes, and everything are distributed. So depends on a ton of factors, but it can be that the firms continues to issue dividends, although they have a tax advantage. It can also be just for dividend signaling and smoothing, that we're gonna come back to later, of saying we still have money, look at this, even though it's not optimal for you, we can show you we have the money and we pay dividends because we have the money, right? So it just can be like an ego matter as well. So that's just something you have to know. Firms can continue to issue dividends, although they have a tax advantage. How can they ask you that in the exam? They can say, which of the following is correct? And then dividend puzzle is firms continuing to issue dividends, although it has a tax advantage. That would be correct. And that's something they always love to ask. So all of the things we just covered so far, the homemade dividend, the share purchase, the dividend payout, everything here is extremely important for the exam. This is something they love to ask in multiple choice questions, and we're going to see it when we practice. Of course, if you have any questions, please feel free to stop me, otherwise I continue, right? So we've also got the effective dividend tax rate. That's something they can ask you to calculate. So what is the effective dividend tax rate? We have this big formula here just to lead to the conclusion that the effective, so how do you know it's effective? Because there's this star here, is the dividend tax minus the capital gain tax divided by 1 minus the capital gain tax. And that's the effective dividend tax rate. That's how you calculate it. And of course, you have differences across investors. So rates differ due to the income level, investment horizon, tax jurisdiction, country you're in, as I just mentioned before. And of course, long-term investors are more heavily taxed on dividends, so they would prefer share purchase over dividend payment. That's just an example. And yeah, this formula is one you have to remember always for the exam as well. You don't have a formula sheet for MFA, so that's something they could easily ask you to calculate. I see a question in the chat. Will we get the slides afterwards? So I explained that at the beginning. Maybe some of you were not there. But yeah, I will send the slides in the IB group chat, the 2024 group chat, after my last free training. So all the free trainings are the same. So I have one today, one tomorrow, and one on Tuesday. And after the one on Tuesday, I'm gonna send the slides to the group chat so that everyone can see them, right? So yeah, you'll get them on Tuesday. Okay. Great. Moving on to dividend captures and tax oriented. So a corporation that chooses to invest its cash will prefer to hold stocks with high dividend yields as it can exclude 50% of dividend received from corporate taxes. So just an example, not extremely important for the exam, just to show you how it works in real life. But we've got something quite important, is the clientele effect. So clientele effects is when the dividend policy of a firm is optimized for the tax preferences of its investors. So imagine we have, I don't know, long-term investors that prefer share purchase over dividends because they are taxed more heavily on dividends. Then the company will adapt their structure to their own shareholders. And then they will say, okay, if you prefer share purchase, fine with your share purchase. And we want to please you with your shareholders. That's the clientele effects. We've also got the dividend capture theory that states that absent transaction costs, non-taxed investors don't have to hold the high dividend paid stocks all the time, only the moment when the dividend is paid. So if you have I don't know, investors that don't tax, you expect a high trading around the ex-dividend date, around that date, right? Because we know that after that date, you are not anymore entitled to a dividend. So for those who are not taxed, then it's the moment to sell or buy. And then for those who are more heavily taxed, it would not be optimal to buy directly from the ex-dividend date because they would have to pay a tax on the dividend, which is something they don't really want to because they tax more heavily than if they just hold the share, sell it later, and have a capital gain. That's why you have a lot of trading around the ex-dividend date in order to benefit the most from the taxes. All right, retaining cash with perfect capital markets. So if a firm retains cash, it can use those funds to invest in your projects. However, once the firm has already taken all positive NPV projects, any additional projects are zero or negative NPV investment. That's just a theory from the MM world. So of course, in the perfect capital market without taxes, buying and selling securities is a zero NPV transaction. So it should not affect the firm value, sorry. Shareholders can make any investment on their own if a firm pays out cash. So basically, the choice of buying and selling securities has zero effect on the firm. It's a zero NPV transaction. Which leads us to the payout irrelevance that if a firm invests excess cash flows in financial securities, then the firm's choice of payout versus retention is irrelevant. It does not affect the initial value of the firm because we are always in perfect capital markets. Of course, in real life, it's not exactly the same, but in perfect capital markets, it's always how it works. If there is no further question, we can then move on to the effective tax disadvantage of retaining cash. It's also a formula that is quite big, annoying, but that you have to remember always. So 1 minus the corporate tax rate times 1 minus the capital gain rate over 1 minus the interest income tax rate. So we have here all different components. How can they ask you this? Very stupid, but they give you the corporate tax rate, they give you the capital gain rate, and they give you the interest income tax rate. And they ask you what is the effective disadvantage of retaining cash. And it's something they ask every year in the exam as well. So you just have to apply this formula, get the numbers from the question, and just plug them in to get the effective disadvantage of retaining cash, right? That's just how it works. So of course, you're not gonna practice with that because it's just plugging numbers, but of course, it's something they can ask you as well in the exam. So pay attention to that. All right, last topic for this chapter, dividend smoothing and signaling. So dividend smoothing is basically a practice of maintaining relatively constant dividends over time. Why? Even if they have a better year, they keep the dividend kind of stable. Even if they have a bad year, they don't have that much earnings, they still pay out the dividend to say that no matter what, they are stable, they're still in the market, they can still pay a dividend. That could be a nice signal to investors to say, hey, this firm is a trustworthy firm. We can invest in them. They are doing good, and no matter what's happening, they still are able to pay dividends. So that could be a positive sign for investors. Moving on to dividend signaling, which is basically the changes in dividends that reflect the manager's view about the future earnings. So let's say they just had a crazy year, so many earnings, so many good things, they pay a very high dividend. Let's say, hey guys, we're doing great, invest in us, look at how much money we have, we're even paying out to you. Can be the opposite. Very bad year. Hey guys, this year was terrible for us. This quarter was very bad. We pay a lower dividend because we can't afford it. So these can have an impact on the way managers see the firm in the future. And this can also have an impact on, of course, investors, because if the managers think the future is bright, of course, investors also think the future is bright. And if it's the opposite, it's the opposite also for investors. So that's basically the difference between smoothing. Smoothing is always the same. Signaling is changing regarding their own earnings. Last but not least, stock dividends and splits. So we can have a stock dividend that is not taxed. You just pay a dividend instead of cash, what we explained earlier. And we can have a reverse split, which is reducing number of shares outstanding to then increase the share price. Because we said before, if you don't change your assets, so here we just change the number of shares outstanding, we reduce them, then of course the earnings per share get higher because we have less shares outstanding, the same value, so that would be very beneficial. And then last but not least, a spin-off is the distributing shares as a subsidiary. That can also happen in real life, but it's less common, right? Any questions about what we covered so far? Because then we're going to practice with past exam question for the remaining 15 minutes, and we should cover everything that is exam relevant for that. All right, I see no questions. Of course, if you have any, please feel free to ask me now, later on WhatsApp, whatever. And with that being said, we can move on to past exam questions. The first one being, which of the following statements is incorrect? And we're going to have a lot of those incorrect, correct ones. So that you think a little bit, once you have your answer, you can type in the chat and then we'll solve it all together. So go wait a few more seconds and then you're going to be able to solve it all together. Perfect. I received a few answers again. Very good job from everyone here. So let's check every single statement and check which one is correct, which one is not. So A, from an accounting viewpoint, dividends typically decrease the firm's current or retained earnings. That's correct, right? Because if you pay a dividend, then the earnings are lower because you have less money uh, available later on for future investments or whatever you were planning. So with the money you have, with the cash you have, you pay a dividend. So that's correct. A is correct. B, the method the company uses to decide between paying dividends and retaining cash is known as payout policy. That's the entire topic of the chapter, right? That's correct. So that's a big choice. Do you retain cash or do you pay dividends, right? And C, the majority of companies that pay dividends do so on a semi-annual basis. That's not correct. I said at the beginning, a firm can pay, I don't know, every quarter, every year. Doesn't really. There's not a rule for that, so they can do whatever they want, and there's not the majority of companies that pay on a semi-annual basis. It really depends on companies, so there is no majority in there. So C is incorrect. Let's check D. Occasionally, a company might issue one-time special dividend that is generally much larger than regular dividend. That's also correct. That's what I said before. The special dividends when, for example, they had a very good year and they want to thank their shareholders by paying a high dividend, a special one. So A, B, and D are correct. C is wrong. Very good job. Guys, we can then move on to the next question. Another method to buy back shares is the where the company provides various prices it is willing to pay for shares, and shareholders then specify how many shares they are willing to sell at each price. Once again, once you have the answer, you can send me in the private chat. I see some of you already did. Very nice job, everyone. All right, very nice job, everybody. We can then check it out all together. So we have got four options: standard offer, Dutch auction repurchase, targeted repurchase, open market repurchase. Let's check it out. So here the answer is B, Dutch auction repurchase, because we know that when a company provides various prices when they're paying for shares, shareholders specify how many. I said it's kind of the mix and match we discussed earlier, right? So I can sell you X amount for that much, I can sell you this for that, and you basically match your prices with what you're willing to buy and the shareholder what is willing to sell, right? Every time. The targeted repurchase is basically when you target one shareholder, you buy everything from him. Open market share purchase is when you buy from directly the open market, so from the stock exchange, and tender offers when you basically buy at a small premium some shares to a specific investors in general, just to get the price you want. Very nice. Two questions so far. You got them right for, I think, everybody. So that's very nice. Let's continue with that. I'm very happy with what I'm saying, guys, because these are exam questions every time. So that's extremely important to practice with. This one may be a bit more difficult. Which of the following statements is incorrect? Once again, I'll leave you some time to think. And if you're done, you can send me in the chat. If you have questions, you can also send me in the chat and we can discuss that later on. last few seconds to think about it, and then we're gonna solve it all together. All right, very nice again from everyone. I think you're doing really, really good, to be very honest. So let's check the answers. So which statement is incorrect? We're checking for the wrong one. A, in perfect capital markets, assuming the firm's investment policy remains unchanged, blah, blah, blah. The choice of dividend policy is irrelevant and does not influence the initial share price. That's correct, right? Because we know that if you pay a dividend or if you actually do a share repurchase, right? At the end, it does not affect the initial share price and it doesn't change anything. So A is correct. B, in the perfect capital market, the stock price falls by the amount of the dividend once the stock starts trading ex-dividend. That's correct also because we said the ex-dividend date is the date at which you cannot have the dividend anymore from buying the shares. So of course, the stock price falls by the amount of the dividend, and we explained why, because we have less assets and we have less basically market value to divide per stock. So we have a lower price that drops by the amount of the share. By the dividend, sorry. So A is correct here and B is correct. Let's check out C and D. C, in 12 capital markets, a share purchase on the open market does not change the stock price and the price is equivalent to the ex-dividend price as if a dividend had been distributed instead. That's incorrect because the stock price does not fall by the amount of the repurchase because the share purchase reduces the number of shares outstanding and then the value of the firm decreases by the amount of the spend on the repurchase. So the share price remains unchanged and is not equivalent then to the ex-dividend date, right? That's the mistake in there because it remains unchanged and the value actually decreases of the firm. And in D, let's check it out. So D, in perfect capital markets, investors are indifferent between receiving funds through dividends or a share buyback. Then by reinvesting dividends or selling shares, they can replicate either payout method themselves. That's again correct because we know that if we follow the logic that we explained earlier, we said there is a theorem that says that they are completely indifferent between having a share repurchase or a dividend in perfect capital markets without taxes. Because we said if we introduce taxes, it's a bit different. But without taxes, they are completely indifferent. They can reinvest the dividend or they can sell a part of the shares to replicate the cash method that they receive. So D is correct. Very nice, everyone. No more question I see in the chat. That's very nice. We can move on. So we still have 3 questions, but before we move on, I would just like to know right now what would be a confidence level of these 2 topics. Now that we discussed them quite extensively. So of course there's still a question afterwards, so no, no worries. But I'd just like to know, compare your initial confidence level to your current confidence level that you have right now, and to see. All right, I see a 9 here. Very nice. Maybe more inputs. All right, an 8. I see people going from 6 to an 8 to a 9. That's very, very nice. Any more inputs? 8. Cool. Very happy to hear that. Maybe one last. All right, another 9. So I'm super happy, guys, that I could help you out. Just before we continue to the next question, I would just like you guys to take 30 seconds to finish this evaluation form. It will help me a lot for my reference in the company as well. So if you think this course was worth it, please just let me know. You can scan this QR code. So just takes 30 seconds. You fill in 5 questions. And I would like you guys, if this course was not a 10, to basically give me feedback and tell me what I could improve for a free training. Remember, it's a free training, right? To make this course a 10, because I always want to improve. I always want to make it better and better. So, of course, if you think there are things I should improve, please, feedback is much appreciated. It will really help me a lot. And of course, if you think it was good, then I'll take the 10. But yeah, just give you a few seconds to do that. Once you're done, you can type that you're done in the chat so that I know that everybody's done and that we can move on to the remaining questions. Just waiting to get a bit more evaluations. See only 2 people fill it in, and then we'll be able to move on later on. Just need a bit more input. Ah, I see that in the chat again. Amazing. Thank you very much, guys, for taking the time of filling in the evaluation. Really appreciate it. It helps me a lot. Really, thank you. Moving on to the next question then, which of the following statements is incorrect? So we've got, again, 4 different types, and I'll let you work a little bit on it. If you have questions, of course, always tell me, and I'll be glad to help you out. All right. So I received once again a lot of very good answers. Sorry, very nice from everybody. So let's check it out. Which statement is incorrect? A. When a firm distributes dividend, shareholders are taxed at the dividend tax rate, and if the firm purchases shares, then the shareholders are taxed at the capital gain rate, and they can recreate the homemade dividend. That will be taxed at the capital gain rate. So that's correct. That's basically what we said. Uh, That's what we explained earlier. You can have the homemade dividend and you are taxed on the capital gain rate rather than on um, the dividend. So A is correct. B, if the tax on dividends is higher than the tax capital gain rate, then shareholders will occur lower taxes if a firm uses share repurchase to for the payout rather than paying dividends. That's logic, right? So you get more money if they use a share repurchase, so a capital gain rather than a dividend that is tax heavier. So B is correct as well. And C, firms that pay dividends must offer a lower after-tax return to provide investors with the same pre-tax return as firms that use share buybacks. So why is that statement incorrect? So the firms that pay dividend must offer a higher pre-tax return to compensate for the investor for a higher tax burden, right? So they will not pay a lower after-tax return for the investor to be better off. They have to pay a higher um, pre-tax return to provide investors with the same pre-tax return as the firms that use the share buyback. And then D, the optimal dividend policy is when the tax dividend rate is higher compared to the capital gain tax rate, then it's to pay no dividends at all. That's also what we said. So very good. I see no question in the chat. If you have any, please feel free to stop me and we can move on to the last question we have for today. Another multiple choice theory question. So which statement is incorrect? And then we'll be done for today. All right. Very good. Once again, for everybody, very, very good. Once again, so let's check out the answers. Which statement is incorrect? I get one more question. Yeah, amazing. Have you one more? I think you got 100% correct today. Every question you got them right. So congrats. Honestly, very nice job. Hey, the practice of keeping dividends relatively stable is referred to as dividend smoothing. That's what I said earlier, right? Dividend smoothing, everything kind of stable, signaling ups and downs depending on the earnings. A is correct. B, the dividend capture theory suggests that we would observe significant trading activities in the stock around the ex-dividend date, as investors with low tax rates sell, while those with higher tax rate buy in anticipation of the dividend, and the reverse, and then reverse those trades shortly after the ex-dividend date. Why is that not correct? It's basically because it's the opposite. Investors with high tax rates sell, and investors with low tax rate buy. Why? Because if you have a high tax rate, rather than receiving the dividend in cash right after the ex-dividend date, then of course, if you are taxed more heavily, you would still sell it, get the benefit of the share price that stays the same, and continue with capital gain tax that is taxed lower than the dividend, right? So it's the one with the high taxed the high taxed investors that will sell and the low tax one that will buy because it will have the benefit of the dividend, which is taxed at a lower price. That's the logic. If you have a high tax rate, you sell. If you have a low one, you buy. C, reverse stock split reduces the number of shares outstanding, as a result, increases the stock price. That's correct. What we explained, we have less shares outstanding, still the same market value, so the earnings per share are higher. And then D, according to dividend signaling hypothesis, changes dividends communicate managers' expectation regarding the company's future earnings. We said signaling is ups and downs depending on the expectations and the earnings. So up, high earnings, down, lower earnings. Right? No questions? I see. If you have any question, you can Once I said this, I send the slides in the group chat, of course, you can have a look at them again, see if there's anything you would like further explanations on. If so, you can always feel free to text me. I'll be very happy to help you out. And apart from that, thank you very much, guys, for attending. It was a joy to teach you guys today. Nice participation, nice answers every time. Very nice.